Welcome to Corporate Finance. Welcome to problem solution videos of Ross Westerfield and Jordan's Introduction to Fundamentals of Corporate Finance, 13th edition, most popular finance book in the United States for intro and MBA finance classes. Number one, they tell me. And we're going to use these problem set videos to solve the problems at the back of each chapter. These are the questions and problem sets at the back of every chapter, and those are the ones we'll be working on. So I hope you enjoy them. Basically, we want to be able to do three things. Number one, fundamentally most important, understand the mathematics of how to do these problems, because if you do that, you can do these on paper, you can do these in your financial calculator, in your business calculator, and most importantly in Excel. But it's fundamental to understand the mathematics of it all. You'll notice that when I do these problems, they're all going to be in a format of given equation solution. So every single problem you'll notice has given equation solution. I strongly recommend that you do that on your Excel problems. It's a way of thinking, and it helps you sort out the solutions and usually get the problem right. So I highly recommend you go give an equation solution on every single problem we're going to do in this textbook. This is version 2.0 of these problem videos. In version 1, I did these problems on a light board and wrote them out by hand. Now it's becoming increasingly important to type them into Excel. And so we're going to record these in an Excel spreadsheet for all sessions, and you'll be able to follow along right in Excel. So today we're going to start with Chapter 2. Chapter 2, Problem 1. Again, these are from the questions and problems section of every chapter at the end of the chapter. Chapter 2, Problem 1 says Bing Incorporated has current assets of $5,400, net fixed assets of $28,100, and current liabilities of $4,100 and long-term debt of $10,600. The equation we're going to use is assets, because we're looking for two things. First of all, we're looking for owner's equity and we're looking for net working capital. Notice I've highlighted the answers in these problems. The equation we're going to use is the fundamental balance sheet equation, assets equal liabilities plus owner's equity, and net working capital equals current assets minus current liabilities. These are two really important formulas you must remember forever in your personal and business lives. And now getting to the solution, I simply drop in the current assets from the givens. I drop in the net fixed assets, $28,100, and in cell D11, I type in equal D8 plus D9, and Excel will add those up for you. We also know that on the balance sheet, it's got to be, we learned in accounting class, so assets must equal liabilities plus owner's equity, so I can go over there and type that right in, or just say equal D11, and then I can bring in my current liabilities of $4,100. I can bring in my long-term debt of $10,600, and then this becomes the subtraction. This answer, owner's equity, is subtracting liabilities plus owner's equity minus current liabilities minus long-term debt, and that gives you your owner's equity of $18,800 to balance out the balance sheet. The second question in this problem, they want to know what is working capital, and working capital is very simply current assets minus current liabilities. So that would be cells D8 minus G8, and you get net working capital of $1,300. And there are your answers to problem number 1. In problem number 2, we have Natero Inc. has sales of $742,000, cost of $316,000, depreciation expense of $39,000, interest expense of $34,000, tax rate of 21%. What is the net income, or NPAT, net profit after tax? The equation we're going to use is sales minus cost equals net income, so I type that in. And then I build a vertical income statement, as always, going all the way down to swoosh, swoosh at the very bottom under net income. So for sales, I just bring in my givens, $742,000. Costs are $316,000, also given. Depreciation is $39,000, also given. And then earnings before interest and taxes is simply sales minus cost minus depreciation. D21 minus D22 minus D23, and I get $387,000. Moving on, I bring in my interest expense and subtract it out. $34,000 to get earnings before taxes, or EBT, and that's simply cell D24 minus D25. Next up, I have to take taxes on that. Taxable income or earnings before taxes, sometimes called PBT, also profit before taxes. So I take 21% times cell D26, which is your EBT, and I get taxes of $74,130. And then for my net income, or NPAT, I take equal D26 minus D27. Notice that all these formulas that I've been typing in start with an equal sign. Back in Lotus 1-2-3 days, that was a precursor to Excel. It used to be plus D26 minus D27. I think Bill Gates might have taken that technology, it looks like, because that looks awfully similar. He just put an equal sign at the beginning of all his Excel formulas. Problem number 3, Natera paid $125,000 in dividends. What are your additions to retained earnings? Well, we know that if you look at net income as a total pie, there are two things I can do with net income, and that is I can keep it or give it away. Keep it all or give it all away, or any proportions of each that I want to do as a board of directors. So anyway, in this case, this company, out of their net income, paid $125,000 in cash dividends. What are the additions to retained earnings? Additions to retained earnings is equal to net income minus the dividends. And so my additions to retained earnings are cell D28 equal D28 minus 125,000. Alternately, I could put 125,000 up here in a blank cell, and that's probably a better use of Excel, because then I can just go equal this cell, which is D28 minus the new cell, wherever you put the $125,000 of cash dividends, and you can type that formula in here instead. That's a little safer, because that way if you change the dividend number to, let's say, $150,000, that answer would automatically change. So that's a better way of doing Excel. For quickness purposes, I just typed in 125,000. In problem number 4, what's given is Natera has 75,000 shares outstanding, and we want to know what are the earnings per share and dividends per share. The equation is earnings per share equals net income over total shares outstanding, and dividends per share is equal to dividends divided by total shares outstanding. In the solution, earnings per share, I will just go in and take cell D28 divided by 75,000, and I get $3.72 approximately per share. For dividends per share, similar fashion, I take D28 minus D35 and divide that quantity by 75,000 shares, and that gives me about $1.67 per share. Those are your answers to problem number 4. In problem number 5, Timmy Tappan is single, had $189,000 in taxable income. Using the rates in table 2.3 in your text, calculate his income taxes. What's his average tax rate, and what's his marginal tax rate? And know these two definitions are very important. So the basic way we do this problem is to step through the tax brackets in table 2.3 and calculate taxable income. And then I can calculate the average tax rate across all those bands and the marginal tax rate. So the formulas are average tax rate is total tax divided by total taxable income. So total tax bill divided by total taxable income. And then the marginal tax rate is the rate on one more dollar of taxable income. So I go into Chapter 2, Table 2.3, and I look at the various and sundry tax brackets. The first, 9875, is taxed at 10%, and that gives you $987.50. The second bracket is 12%, and that's taxed on the difference between $40,125 and $9875. That gives you $36.30 of taxes. The next tax bracket is 22% on the difference between 85,525 and 40,125. That gives you 9988 of taxes. Next tax bracket is 24%. And notice how as the income goes up, the tax rates go up 24% on any difference between 163,300 and 85,525, giving you 18,666 of taxes. And then finally, the last tax bracket to take you up to the 189,000 in taxable income is 32%, and that's 32% on the difference between 189,000 and 163,300, and that gives you $8,224 of taxes. Add all those up using the equal sum function, equal sum D56 colon D60. That takes all of these tax brackets into account, and it gives me a total tax bill of $41,495.50. Then to answer the question, the average tax rate is total tax bill equal D61 divided by taxable income, 189,000, and I get an average tax rate of 21.96%. And then the marginal tax rate is what would I pay on one more dollar of income? Well, if I had made $189,001, that would still fall into the 32% bracket. And so my marginal tax rate on one more dollar of income is 32%. And those are your answers to problem number 5. In problem number 6, Graf Incorporated had sales of $49,800, cost of $23,700, depreciation expense of $2,300, interest expense of $1,800. Looking at those categories, that looks a lot like an income statement to me. The tax rate is 22% in this company, and they want you to calculate the OCF, or operating cash flow. So my equation for OCF, whenever I see the letters OCF, I know I have to build a P&L. P&L is a profit and loss statement. That's also known as an income statement. Sales minus cost equals net income. So again, I just bring into this income statement my givens: $49,800 of sales, $23,700 of cost, $2,300 of depreciation. That leaves me with an EBIT of $23,800, and that formula is equal D71 minus D72 minus D73 to get that EBIT. From the EBIT, I deduct interest expense of $1,800 to get the profit before tax, or earnings before tax, earnings being the same thing as profit. EBT is $22,000 even. My taxes at 22% of that are then $4,840. I simply take 0.22 times D76, sell D76 to get my $4,840, and then my net income, or NPAT, is equal to D76 minus D77. Again, starting all of these equations off with an equal sign, equal D76 minus D77, and enter, and you get 17,160 for your NPAT, or net income. Then moving over to do the OCF, my formula for OCF is EBIT plus D minus T, and I can simply go over and reference the cells. So my EBIT is cell D74, so I could put, to bring that over, I bring equal D74. I want to add in my depreciation, so I go equal D73. I want to add back depreciation because it's a non-cash expense. I'm looking for cash. Operating cash flow. So since it's a non-cash expense, I need to add it back. I took it out to get to EBIT. I need to add it back in. And then my taxes are equal cell D77, 4840. And to get my OCF, I simply take G72, equal G72 plus G73 minus G74, and I get an operating cash flow of $21,260, and there are your answers to problem number 6. In problem 2.7, we have Wallace Driving School with 2020 net fixed assets of $2.3 million, 2021 net fixed assets of $3.1 million. So 2021 would be your ending values, and 2020 would be your beginning values. Your 2021 depreciation expense is given at $327,000. What is net capital spending? NCS. Formula is for NCS is equal to NCS equals ending net fixed assets minus beginning net fixed assets plus depreciation. An easier way to solve this would be if the author only gave you gross fixed assets, you'd take ending gross minus beginning gross fixed assets and you'd be done. You wouldn't have to gross it up. But since he uses he uses net fixed assets, you have to take ending net fixed minus beginning net fixed plus depreciation. So that's what we're forced to do. All of that information is given. So your ending net fixed assets are 2021, 3.1 million. Your beginning net fixed assets are 2.3 million. That's 2020. And then I add back the depreciation of 327,000, and I get an answer of $1.127 million by taking equal D85 minus D86 plus D87. There's our answer to problem 2.7. Moving on to problem 2.8, we have Dugan Incorporated showing 2020 current assets of 5320 and 2020 current liabilities of 2510, your current assets and your current liabilities. They also show in 2021 or ending numbers, current assets of 5970 and 2021 current liabilities of 3240. And they want to know what is the net working capital, change in net working capital, CNWC. We know that change in net working capital is ending minus beginning. And the way we calculate net working capital is current assets minus current liabilities. So very, very important formulas here. So I just take the 2021 numbers, subtract out the 2020 numbers, and that will give me my delta or change in net working capital. So for ending net working capital, it is 5970 in 2021 minus 3240. And the beginning net working capital for 2020 is 5320 minus 2510. And if I subtract those two numbers, which would be D98 minus D99, I get an answer, a delta of negative 80. Now, a safer way to do this, again, would be to create a table over here where you posted your 2021 current assets and current liabilities, and then your 2020 current assets minus current liabilities, and then do the delta, and then that delta would fall out. The advantage of doing that separately like that rather than embedding it in a cell like I did for expediency, you want to take the time and put it into a little table. That way, if any of those numbers ever change, your answer will change immediately with it. So that's your answer to number 8 minus $80. In problem number 9, we have Osaka's tennis shop with 2020 long-term debt of $2.25 million, 2021 long-term debt ending of $2.66 million, interest expense for 2021 $305,000. What is cash flow to creditors, CFTC? Formula is cash flow to creditors equals interest expense paid minus net new borrowing. And where do we get net new borrowing? Well, it comes off the balance sheet, because I've never seen the word borrowing on any financial statement that I can recall. But I know that long-term debt is basically borrowing. So ending long-term debt minus beginning long-term debt. And I have seen long-term debt on the balance sheet, so it's very easy to calculate. So I just take my interest expense paid that was given. I take my net new borrowing, which would be $2.66 million in 2021 minus $2.25 million in 2020, and I get a net new borrowing amount of $410,000. So year over year, we borrowed an additional $410,000. And to calculate my cash flow to creditors, I take interest paid, cell equals cell D108 minus cell D109, and I get a cash flow to creditors of negative $105,000. And there are your answers to problem number 9. In problem number 10, we see that Osaka's tennis shop has 2020 common stock of $780,000 and 2020 paid-in surplus of $4.78 million. They also had 2021 common stock of $965,000 and 2021 paid-in surplus of $5.04 million. These are two of the key accounts that comprise your equity account on the balance sheet. When you add them together, there are others, but these are two of them. 2021 dividends were $654,000. What is cash flow to stockholders? So our equation is cash flow to stockholders equals dividends paid minus net new equity raised. And net new equity raised is simply ending equity 2021 minus beginning equity from 2020. So we set up a little table. We have our common stock listed first for 2021 and 2020, and then we have our paid-in surplus for 2021 and 2020, and then a delta column to see the change over the years. So my common stock has gone up $185,000. My paid-in surplus has gone up $260,000. And my overall total equity account has gone up $445,000. Now, to calculate the cash flow to stockholders, I take $654,000 of dividends paid minus the change in the equity, net new equity raised of $445,000 from cell F122. So I take $654,000 minus F122. And I get cash flow to stockholders of $209,000. And that is your answer to problem number 10. In problem number 11, Osaka Tennis Shop had net capital spending of $1.5 million. It reduced its net working capital by $55,000. What was this 2021 OCF? This problem's a little more tricky and complicated. As we get higher and higher in the numbers, the problems get more and more intermediate. So we'll do a couple more. What was their OCF in 2020? Now, one way we can calculate OCF is by using the income statement, EBIT plus D minus T, if we're given an income statement. In this case, we're not. So we have to use another method. We use free cash flow, CFFA, cash flow from assets, is equal to cash flow to creditors plus cash flow to stockholders, but it's also equal to OCF minus NCS minus CNWC. So now we can use, since those things are all equal, we can use those equations to move things to the other side and solve for and isolate OCF. OCF then is equal to cash flow to creditors plus cash flow to stockholders plus net capital spending plus change in net working capital by moving those last two items over to the other side of the equation with a change in sign. So cash flow to creditors from a prior problem was negative $105,000. Cash flow to stockholders from a prior problem was $209,000. Net capital spending was given at $1.5 million. And the change in net working capital went down, so I need to put a minus sign in there of $55,000. And then to get my operating cash flow, I take the summation of all four of those cells. So equal sum D132 colon D135. That Excel tells Excel to add all those together. Or I can do it separately, equal D132 plus D133 plus D134 plus D135. It's a little more tedious. The equal sum is more convenient. And I get an OCF of $1.549 million. That's your answer to problem number 11. And finally, we have problem number 12. Klingon Widgets purchased new cloaking machinery 3 years ago for $6 million. The machinery can be sold today or liquidated for $5.4 million. Net fixed assets on the balance sheet on my books shows $3.5 million. That means it's been depreciated from its original $6 million purchase price. Current liabilities are $945,000 on the books on the balance sheet, and net working capital is $275,000, also derived from the balance sheet. Current assets and current liabilities, market value, they could be liquidated or sold today or paid off today for $1.25 million. What is the book value of total assets, and what is the market value? And I think in this case he's asking for a market value of net working capital plus net fixed assets. So I create myself a little table with headers, book value, and market value, and I list on the left side my current assets and my net fixed assets. And that will give me my total assets. So for current assets, I have I have to calculate it actually, so I get down to the bottom, and the way I calculate current assets is by taking net working capital plus your current liabilities, and that's because net working capital equals current assets minus current liabilities. If I want to solve that equation for current assets, I have to add net working capital plus current liabilities, and I get an answer of $1.22 million. Put that into the books. That's on in the book value on the balance sheet. So I just bring that cell D154 right up there into cell D148. The given net fixed assets in the givens on the books are $3.5 million, and when I add those two pieces together, my total assets are equal to $4.72 million. In the market value, I have to look at the liquidation value of these things. So my givens, it says my current assets and current liabilities could be liquidated for $1.25 million. In other words, I would sell all my current assets and pay off my current liabilities, and that value of net working capital is equal to $1.25 million. And my net fixed assets, if I sold my machinery that I bought for $6 million, today I could sell it for $5.4 million. So out in the market, my market value of net fixed assets is $5.4 million. Add those two together, equal E148 plus E149, and I get a market value of $6.65 million, and that is your total market value of your net working capital plus your net fixed assets. And there are the answers to problem number 12. Hopefully you've enjoyed all of these Chapter 2 problem solution videos.